In this video, we're talking about how a banking crisis might tilt the economy into a mild recession later this year. It seems like the Federal Reserve is trying to get ahead of this potential problem by releasing documents indicating a few possible repercussions from the failure of Silicon Valley Bank and other financial sector issues that began in March. It seems as though they're trying to dampen a fire before it flares up. Now, before we get into this too far, let's all take a deep breath. I know this kind of news can be unnerving. But let's break it down into bite-sized pieces. First, the Federal Reserve's staff economists say the banking sector is sound and resilient. That's good to hear. However, they believe the economy will still take a hit, and their projection at the time of the March meeting included a mild recession starting later this year with a recovery over the subsequent 2 years. Let me say that again. They're expecting a mild recession later this year with recovery over the next 2 years. If it takes 2 years to recover, you can expect some pretty severe recession fatigue after a time, and there'll be a lot of frayed nerves. This all sounds a bit bleak, but we should keep in mind that projections can change, and the Federal Reserve has a few tools in its toolkit to keep the economy chugging along. As far as the experts go, when it comes to the Federal Reserve, there are those that are screaming the Fed has overshot the mark in terms of hiking rates, and there are those that say they haven't gone far enough. The single, simple message this presents is the fact that no one knows what to expect, really. Furthermore, we should note that projections following the meeting indicated that Fed officials expect GDP growth of just 0.4% for all of 2023. However, with the Atlanta Fed tracking a Q1 gain of around 2.2%, that would indicate a pullback later in the year. In order for those numbers to balance out, that's going to take quite a bit. The Federal Open Market Committee voted to increase the benchmark borrowing rate by a quarter point, bringing the Fed funds rate to a target range of 4.75 to 5%, its highest level since 2007. This rate hike came less than 2 weeks after Silicon Valley Bank, at the time the 17th largest institution in the U.S., collapsed following a run on deposits. The failure of SVB and two others spurred the Fed to create emergency lending facilities to make sure banks could continue operations. Now, since the meeting, inflation data has been mostly cooperating with the Fed's goals. Officials said at the meeting they see prices falling further, reflecting the effects of less projected tightness in products and labor markets. Core inflation was forecast to slow sharply next year. However, concern over broader economic conditions remained high, particularly in light of the banking problems. Following the collapse of SVB and two other institutions, Fed officials eased conditions for emergency loans at the discount window. The minutes noted that the programs helped get the industry through the troubles, but officials said they expect lending to tighten and credit conditions to deteriorate. Some policymakers questioned whether to hold rates steady as they watched to see how the crisis unfolded. However, they ultimately relented and agreed to vote for another rate hike because elevated inflation, the strength of recent economic data, and their commitment to bring inflation down to the committee's 2% longer-run goal. In fact, the minutes noted that some members were leaning towards a half-point rate hike prior to the banking problems. Officials said inflation is much too high, though they stressed that incoming data and the impact of the hikes will have to be considered when looking forward as to what action, if any, needs to be taken. All right, that's a lot to take in, but in short, here's where we are. The Fed's raised benchmark rate by a quarter point. Projections indicate the GDP growth will be slow this year. Additionally, officials are concerned about broader economic conditions and the potential for a mild recession. The good news is that inflation data has been cooperating with the Fed's goals. The bad news is that borrowing money is going to be tough. Unless something major happens, it looks like the next couple of years are going to be a test, both in patience and resilience. So hang tough out there. If you like this video, tell a friend, give it a like to help me spread the word, and subscribe so you know when the next one drops. As always, I appreciate you and your time. Thanks for watching. Talk to you soon.